Hello and welcome to the Weekend Investing Daily Byte of 18th of June. Another day, another bump up in the markets, and small caps doing much better than large caps. Uh, and the topic of the day is cashing in on India's $5 trillion surge. I mean, I don't know if you've noticed, but India's market cap of all listed entities put together has crossed the $5 trillion mark, which was less than a trillion just 10 years back. So we've been growing in terms of market cap at a phenomenal pace, and the last couple of trillion have come really, really fast, and we'll talk about it uh, later in the session. Uh, in terms of where the markets are headed, you had the Nifty crawl up 0.39%, just like we have been crawling up the last 5, 6 sessions. Today was another crawl up day. The difference was that we didn't give up the gains at the end. In fact, it was a gap up and it continued slightly on the higher side. So, um, not very strong gains on Nifty, but you have to give the credit to the bulls that they've been able to maintain this trajectory well, and the bears have been sent into hibernation for now. Nifty Junior, however, continues to outperform the Nifty in a big way, 0.63% up today as well. A strong trend up there, significantly above the breakout point. You had mid caps again going up by 0.5%, not much of a move, but the consistency of the move in the last 6, 7 days has been phenomenal. Usually, when we have 6, 7, 8 days of consistent move, there will be one harsh, correction day at some point. So one needs to be mentally prepared for that. Small caps also another gap up and actually going nearly 1% up. So small caps, if you see, on the election result day had reached around 14,100 mark, and we are around 17,000 now. So that's a good almost 3,000 points gain, more than 20% gain from the bottom in just a matter of less than 2 weeks. So small caps have actually outperformed a lot of expectations. People were expecting that once this had sort of steadied at this top level, and Nifty was increasing relatively faster than small caps. A lot of estimates were that small caps will stagnate, but Nifty and other large caps will go up. But small caps are not stopping anywhere uh, on the lower side. Bank Nifty also gained very nicely. I think it's a great move on Bank Nifty. It has been consolidating at this level of 50,000. Now we have suddenly moved from 50,000 to 50,500. Private banks have done very well today, and I think the move on Bank Nifty is very, very sort of a high confidence move that is happening here. FII is also the previous session good buying. 2,000 crores of FII buying has come after almost a week, and we've had only 3 or 4 instances in the last 1 month, 5 instances where FII actually were buying. uh, DII is also buying. So I mean, there is enough proof of the pudding that there is buying happening in the market, and that there is no urgency now for FIIs the way they were selling earlier. That urgency to sell doesn't seem to be there anymore. Heat map today, mixed bag. But as I said, ICICI Bank, Axis Bank, and HDFC Bank all moving up. So private banking as well as some PSU banks also moving up. IT stocks, Infosys and Wipro in particular, moving up. Then you had stocks like Power Grid, Titan also move up. Maruti and Tata Motors gave up some ground. FMCG was giving up some ground. Cement and steel were also soft. Uh, so it was a bit of a mixed bag on the Nifty front. On the Nifty next 50 stocks, you had fantastic gains in HAL, BEL, uh, and also Geo Finance, Bosch India, Motherson, DMart, Trent. These were some of the big gainers, and you had some losers in ABB, Siemens, Zydus Life, LIC, etc. So again, a good mixed bag on the Nifty Next 50. Some of these public sector stocks are just defying gravity, and while some of them may be a bit overstretched, yet as momentum investors, we will continue till the winners themselves give up that current momentum. Real estate once again proving to be the best of the lot, 1.9% up. Uh, for the week gone by, We are now up 5%, for the month 15%. So top ranking mover for the day, for the week, for the month, for 3 months, and for 12 months. So this is the amazing part of real estate that has played out. And at every stage, whether it was 12 months before, 9 months before, 6 months before, 3 months before, people remained skeptical about it. People remained very nervous about, real estate has gone up too much, it will fall down, so on and so forth. So this again, I mean, you have to step back and see how you're reacting to market moves at every stage. Are you allowing your emotions to get better of you, and that by that logic, not allowing yourself to participate in stocks that are doing well? Or are you allowing the market prices to determine, what to buy and what to sell? Similar is the case with public sector enterprise stocks. Today up 1%, for the week up 4.2%, for the month 5%, for 3 months 25% almost, and for 12 months gone by 117%. Here also people have given up on stocks like HAL, BEL, Kochi Ship, all these fantastic runners at much earlier levels, and they are now afraid to get in because they don't have a framework of how to get in and how to get out. That is very, very essential. Autos, FMCG, metals, and pharma took a backseat today, but not down and out, I would think. I think metals and autos are still doing quite well along with pharma. FMCG is where some pain is there on a weekly basis also, but on a 12-month basis, it has just eked out 9%. So private banking, which did well today at 1.1%, and FMCG, these are the two sort of laggards for the last 1 year, along with some, you can say, even Bank Nifty overall. So if you were heavily invested in Bank Nifty or in private banks or in FMCG, obviously your portfolio did not do as well as other portfolios that was open to PSU banks, energy stocks, public sector enterprise stocks, or real estate stocks, and so on and so forth. So sector selection and automatic sector rotation in your strategy is a must. Uh, Real estate, as I mentioned, doing extremely well. We have now gone from 900 odds to 1150 since the election result. So another 20% gain has come right here, 1.8% for the day. On a very long-term scale basis, this was a 2008 peak, and then for the next 6 7 years, the real estate index continued to drop, and 2016 is essentially where the tables turned, and it just kept going up and up and up. This in 2020, COVID was only one place where the previous pivot was challenged. Otherwise, it was higher lows, higher bottoms, higher lows, and higher bottoms all the way through that. Uh, Nifty Private Bank Index has done well today, 1.1%. I think despite HDFC Bank not doing so well, is finally Nifty Private Bank Index has managed a new high and a new high close. So ICICI Bank, I think, and Axis Bank are leading in the private banking space. For a long-term view, you can see that it has been going slow since 2021 and was really range bound in the last 1 year or so. In terms of stock spotlight, Kochi Shipyard was up 9.3% today. I mean, this stock, which hit a new all-time high in 2022 at near 200 rupees, is now 100 times of, sorry, 10 times of where it broke out from. And, it's an amazing run from 230 to 2300. Uh, what probably most investors need to relook at their frameworks is that how to sustain themselves in a run like this. Can you, somehow create a strategy where you have a trailing exit, or you are using some moving average or some percentage drop from the top, something that can keep you in the play. Several of our strategies have had Kochi Shipyard in their portfolio and really enjoying the fruits of this run. But most conventional, discretionary portfolios don't have this stock, and that is exactly the reason. So the stocks that are running hard usually are not there in most portfolios. I mean, it is just the law of the market. The stocks that are falling or stocks that are stagnating will be there in most portfolios, and stocks that are really doing well will not be there in most portfolios because people are afraid of stocks that are going up. It is counterintuitive, it is nonsensical when you think about it. But as soon as stocks start to go up, people are too much afraid of losing that gains, minor gain that they've got, and they get out. And that is exactly the time when the stock is actually saying that I'm going to make a huge move. Please stay on, buckle up and stay on. Gold has gone flat, minus 0.37% today. So the last couple of months, it has been consolidating here. But if we don't break this bottom at around 70,000, I think this flag pattern, once it takes off above 75,000, it will take us to at least, I think, 85 or 90,000. So I think the rest of the year, if we break out above, is going to be extremely, extremely good. So coming back to the 5 trillion market cap that we are seeing on India markets. So this is a chart sourced from Bloomberg, and you can see that we were at 1 trillion in 2007 in the run up from 2004 to 2008. In 2007 we achieved the 1 trillion mark, and then we went to nearly 2 trillion, but then the 2000 the GFC, the global financial crisis, happened, and we came down to less than a trillion, and we sort of stayed in a range between 1 to 2 trillion till about 2016-17. And from there the breakout from that range happened, and until COVID we were still above 2 trillion, but then COVID got us back again to 1.5 trillion. And from that point of March 2020, we have not looked back. And in just less than, I would say, 5 years, 4 years and 1 quarter, we have gone from 1.2 trillion to nearly 5 trillion. So this last trillion has come in very, very short time. This second last trillion has also not taken too much of time, 2 years. So you can see the gap is reducing. 1 to 2 trillion took us 10 years. 2 to 3 took us just about 4 or 5 years. 3 to 4 took us only 2 years, and 1 has taken us less than a year. So this is going really fast in terms of market cap. Of course, the earnings and all those things, the GDP needs to be catching up also, because Warren Buffett has a indicator, and this is the Warren Buffett indicator, that stock market cap to GDP ratio should be around 100 to 120. 1 to 1.2. So if India GDP is somewhere near 3.5 trillion, so 4 trillion is somewhere where the fair market should be at, and we are right now slightly elevated from that perspective. So either if Mr. Buffett is to be right on this, then either the market should come off a bit, or GDP should rise dramatically, and or both should happen a little bit. So but given the context that US market cap to GDP is, I think, sitting somewhere near, uh, I think it is closer to 200%. If I'm not mistaken, I'll go and check back this data. But it is far above India right now, and with there's virtually no growth happening there, I think that indicator is getting sort of re-looked at in terms of its efficacy. But nevertheless, I mean, hats off to the Indian markets to have achieved this feat, and much more to go, I would think, as more and more supply of paper also come in, and more investments also come in. I don't think there is any dearth of runway for the next many decades. So with that positive note, I come to the end of this daily bite. Thank you so much for watching. Do comment below what you liked in this report and what you didn't, and how would you like us to improve it. And do share your thoughts on the market. Thanks. Bye.